We're now past the Thanksgiving holiday, and as normal, new listings and sales are very low this week. Available inventory of unsold homes is now finally falling across the country after rising with mortgage rates late into November. It's looking like we'll end 2023 with a few percent more homes on the market than last year. Home prices will be up year over year, and it looks like we'll end the year with more homes in contract than where we ended last year. That all adds up to positioning 2024 as a very welcome turnaround to one of the slowest sales years in decades. In this week's video, I'll share the latest details on how we're finishing up 2023 and some of the leading indicators for 2024. I also have a statewide view of inventory that might help bring some context to the analysis. This is a critical moment to be on top of the data. We can already see a lot of the 2024 housing market, and the signals are sometimes very surprising. Each month we host our webinar where we spend an hour on all the details to make sure if these trends are durable. Our December webinar is next week, Thursday, December 14th at 10 a.m. Pacific. There's a link to register for that webinar in the description below. Click that. Get it on your calendar, save your spot. These are limited to 1,000 attendees each month. We get a lot more than that want to join. So click that, reserve your spot now. At Altos Research, of course, we track every home for sale in the country every week. We track all the pricing, all the supply and demand, all the changes in that data, so you can understand the market immediately as it happens. I'm Mike Simonsen. I'm the founder of Altos Research, and let's take a look at the data, the latest U.S. housing market data for the first week of December 2023. There are 556,000 single-family homes on the market unsold. That's almost 2% fewer than last week. That's a normal adjustment after the Thanksgiving holiday. Inventory will keep declining through December into the new year, of course. Still, there are 1.2% more homes on the market now than last year at this time. That gap is widening each week. And it looks like we'll end the year with maybe 4% more homes on the market than we ended 2022. That's not a ton, but it reflects how sensitive home buyers are to the spike in mortgage rates that we had in September and October and even into November. Interestingly, to me, a little more inventory is one of the signals that we'll have more home sales in 2024. Slightly more sellers means there is room for slightly more sales to happen. In the inventory chart this week, we're looking at 8 or 9 years of inventory trends. You can see where the supply of homes on the market now at the right end of the chart is and where it has been in recent years. You know, there are still far fewer homes on the market now than in recent years. The supply side of the supply-demand equation remains very constrained. There are more homes available now than during the peak of the frenzy in 2021, of course, but just about the same level of inventory as last year at this time, just a few more on the market, as I mentioned. But what about next year? Will we see more inventory? Will we see sellers come back? Much of that answer it will depend on mortgage rates. So I've included on the chart this week the highlighting of the periods of rising and falling mortgage rates over time. The red and green shaded are the periods where mortgage rates rose or fell over time. In the periods where mortgage rates are low, when mortgage rates are low, that increases demand for homes and decreases the holding costs for real estate. So when holding costs are low, we hold more, we sell fewer, and therefore available inventory declines. Lower rates mean less inventory. For most of the decade, mortgage rates were low and falling. As a result, available inventory fell each year too. In 2018, mortgage rates rose about 100 basis points. That's the red zone that highlighted here. And when rates rise, holding costs for real estate rises. It's higher, so we hold less. As a result, 2019 started with more inventory than the previous year. 2020 saw dramatically cheaper mortgage rates and dramatic decrease in inventory. Last year had a sharp increase in mortgage rates, and that was correlated to a sharp increase in inventory. This year started lower, but finished with rates hit their multi-decade high in October. So inventory rose with rates into October and into November. So you can see the relationship between the shaded areas of mortgage rates rising or falling and the inventory line rising or falling is very clear. Rising rates lead to greater inventory, lower rates lead to less inventory of available unsold homes on the market. So when we're looking at 2024, the news is that mortgage rates have receded off their peak and have been moving lower. That implies that inventory will respond very soon. As long as they stay there, the rates stay there. For buyers who are waiting for affordability to improve next year, maybe as rates fall, the bad news for them is that they're not alone. And so the competition heats up too, and the selection will fall. Rates were up this autumn and inventory rose, but it didn't rise equally across the country. I thought it'd be interesting to take a look at where in the country inventory is up over last year and where inventory is down versus last year. The country has basically the same number of homes on the market as last year at this time, but some states have a lot more homes on the market and some have fewer. In this map, the dark red states have more inventory compared to last year. That's mostly the South, Louisiana, Arkansas, and also Florida and Texas. While the far west and like the Rust Belt Northeast have a lot less inventory of unsold homes than the same time last year. So those are the lighter colored states here. I think it's quite notable that the western states, especially Nevada, Arizona, Utah, those were all among the markets that slowed most abruptly last year as rates rose for the first time. Those states recovered some demand this year, inventory fell, and prices held up. That's not true of the boom markets in Texas or maybe Florida. So I don't have a clear hypothesis why Phoenix recovered better than Austin this year, but it seems really obvious. And Las Vegas is unusually strong. Usually Vegas is among the first markets to break when things go bad. But this year, Vegas was much more resilient than those southern cities. Nevada has 30% less active inventory than last year at this time. The data this week has the last of the holiday activity in it. So new listings volume is way down. Immediate sales were at their lowest level all year. That's normal for the Thanksgiving week, so don't read too much into that. We'll see a little rebound in this coming week, and then a decline weekly through the new year. There were only 33,000 new listings for single-family homes. About 5,000 of those went into contract immediately. We've been watching new listings come in higher each week with slight gains over the same week a year earlier. December, though, is a seasonal low for real estate. And it'll be really interesting to see if those trends continue. A little bit more inventory makes me optimistic for more sales. So we're watching this chart to see, hopefully, new listings growing over last year. And the immediate sales, that's the light portion of the bar. We're looking for that not to contract. That tells us a lot about demand for these homes, these new listings at these prices. Price reductions are now off their peak and heading down for the new year cycle. Currently, 38.7% of the homes on the market have taken a price cut from the original list price. And the fact that the market has more price cuts than normal is a reflection of affordability. It also tells us that demand for these homes at these prices isn't great, but it's actually not deteriorating either. So mortgage rates have been falling for weeks pretty quickly. The same pattern happened last year. And if you follow, so the bright red line is last year's curve, where the year ended where we had a lot of price reductions. Then pick up this year's dark red curve at the left end of the chart, and you'll see how steeply the price reductions were falling to start 2023. in the dark red line. So that was an early indicator this year that home sales prices were going to hold up. We knew in January that there were more buyers than sellers. And when reading that data in January and February like when we were talking about it this year in January and February, there were a lot of people who were incredulous. They were surprised by it. But we could see the immediate demand pickup in this chart. So pay attention to these price reductions line starting January of this year. And here's how you use price reductions as a leading indicator. Homes are on the market. When a mortgage rate spikes and cools the demand, fewer offers get made, and so more sellers who are expecting offers that don't materialize, they have to cut their prices. This happens immediately with that spike in mortgage rates. So we can see very quickly in the price cuts data where home sales will happen in the future. House is on the market now, it takes a price cut in December, gets an offer in January, that sale closes in February. You start hearing about that in March, but we can see it in the data now. So over the next 8 weeks, we will be watching how steeply the price reductions chart falls in 2024. That'll give us leading indicators for home price performance for the whole year, just like it did this year. Mortgage rates have been falling. If they continue to fall in the first quarter, maybe into the sixes, approach 6, I expect we will see similar market behavior. If, on the other hand, rates bounce back into the 7s, stay in the 7s, we'll see less steeply adjusting price cuts. If they rise over 8% again, I suspect that will freeze the housing market. Price cuts will jump early, and that would be very bearish for sales prices for the rest of 2024. As of right now, the signals are for continued support for home prices at these levels. There's nothing in the data now that indicates downward pressure on prices in 2024. It would take a spike in mortgage rates or some other shock to move the data in that direction. It could happen, but it isn't in the data yet. The median price for single-family homes in the U.S. is $425,000 this week. That's unchanged from last week and a couple percent higher than last year at this time. The median price of the newly listed cohort this week is $372,400. That's the bright red line here. That's down a fraction from last week. There's always a price dip over the holiday week, so that's normal. It is notable that the price of the new listings is 6.5% higher than last year. That's the biggest year-over-year price leap all year. Don't read too much into that. It's the holiday week and data can be noisy, but it is notable that homes are getting priced not the other direction. Right? They are being priced over where they were last year at this time. So each week, homes are priced a little bit above where they were last year, and that trend will continue into the new year. Again, assuming mortgage rates don't jump back over 8% again. If you need to help buyers and sellers see this change first, prepare for what's happening, and understand how to act when it does happen, you need to get some Altos Research. People need to hear this data from you. So go to altosresearch.com, book a free consult with our team. We will help you know how to talk about this data, this market with your clients and prospects. There's a link in the description below. Click that to join us. Let's get started.